Well, good morning, everyone, or good afternoon, or good evening, depending on where you've joined me from today. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining us on today's topic, the next major move in crude. Now, before we actually turn this over to Tim Morge, I'm very pleased to have with us today Mark Omens with the CME. So Mark is going to briefly introduce today's product and Tim Morge. So Mark, I'm going to unmute your phone. If you would, please give us a brief intro, and then we'll get started with Tim's presentation. Thanks for joining us, Mark. Welcome.
My pleasure, and thanks for having me, Cynthia. And Tim, nice to see you. And for all of you folks that are our first-time attendees today for Tim, I think you're going to be very pleasantly surprised by the thoroughness that he goes through in his examination of the markets, and today especially in the crude oil market. To begin with, whether you currently trade futures or not, some of the things that we like to try to accomplish from an exchange perspective when we participate in events like today is just to try to make those that have never traded futures a little bit more aware of some of the benefits and why people are attracted to our markets. Regarding the crude oil market, in our opinion, if you're looking to express an opinion in the oil markets, there's no better way than to go to the core and go right exactly to the futures contract, which is the most accurate track, in our opinion, of this market. And with futures, some of the nice things that apply to you as a trader is, number one, our markets are so efficient and they're so fair to all participants. You're going to be trading the crude oil market through Interactive Brokers and into a system called Globex, which is the way that our markets work, so to speak. And in the Globex system, we have what we call a FIFO system. And with FIFO, it's a first-in, first-out system. So no matter where you are in the world accessing the crude oil or any futures market using the Interactive platform, you have the same opportunity to participate in the bid and offer as anybody else around the world. So it's a very fair and open platform. It's very transparent as far as seeing the bid and offers and the size of the bid and offers that are going on in the marketplace. And I think that as you start to trade this market, I think you'll find that our crude oil market has a lot of liquidity, and it's very easy to get in and out from a bid and offer standpoint as far as getting filled at or close to the prices that you're looking to get into the market. But without further ado, what I want to do is I don't want to spend too much time talking from this perspective. If you do have questions about CME or how our markets work, please feel free to send them in, and if Tim and Cynthia would like, they can also forward them to the exchange to get specific answers for you guys after the event. So I don't want to take up too much more time. I want to just thank Interactive Brokers and Tim for allowing CME to be part of this event, and I'd like to turn it over at this point to Tim.
Thank you, Mark. Hopefully all of you can hear me. It's always nice to see everybody from the CME. I had Barbara earlier. Then I had Dave and Mark, another wonderful friend that I've seen at lots of different presentation areas. I haven't seen you in a while, Mark. Great to see you. He just gave you a great description of how the process works. I'd also mention just briefly on the CME staff, if you have a smaller account and you're worried about the size of the regular crude contract, don't worry. The minis are multi-liquid. They're very, very liquid. I have lots of people that trade the minis. They're half the value. So you've got a lot of different options there. You don't have to worry about liquidity in the minis if you decide you want to torque down, or if you decide you want to do 1.5 instead of 1. So you can add it on that way. Options also work very well in this contract, and I'll point. I'm not an options guru by any means, but I'll point out a couple opportunities for you. Before we get started on, let me just go through the things I have to do. Risk and disclaimer. Anytime we talk about financial materials, we have to talk about risk and disclaimer. You can read this while I just give you the brief, dead, blunt introduction, which is this. There is no Holy Grail. If you came to get the Holy Grail from me, I'm sorry, I don't have it. No one has it. The Holy Grail is hard work, good education, in my opinion, trade at a good exchange with good liquidity. The best exchange, the biggest exchange, of course, is the CME group. I have a seat there. We had a seat there since 1980. It's a wonderful place to trade. In volatile markets, be careful. First and foremost, never trade without a stop. Ever, ever, ever. Stops are your friends. They stopped you out, that's okay. Take a break. Look at it again. Last, don't over-leverage yourself. I don't mean this in a bad way. Sometimes brokers will let you trade at what I would say is too much leverage. And instead, you should trade at a... Oops, somebody needs to be muted. I think it's you, Cynthia. Anyway, you need to be traded at a... You need to trade at a normal leveraged amount, meaning too much leverage can kill you quickly. Just relax. There's always more trades. What you want to do is survive. This is a process. So I'm going to dedicate this webcast to my two early mentors, Dr. Alan Andrews. He was a Newtonian physicist in the 1920s. He developed median lines. To me, it's the one true leading indicator that's available to all of us. And Amos Hofstadter, he became the, he wasn't the founding co-chairman of Commodities Corporation, but he was brought on quickly after they started and really brought Commodities Corporation to the forefront as the largest hedge fund for many, many years. And I think, in my opinion, the best campaign trainer or portfolio trader. I've studied individual traders from the past 300 years. He's by far the best campaign trader I've ever seen. And I had a good 4 or 5 years before he passed away tragically in a terrible car accident. But wonderful man and very generous with his time and gave me a lot. And I hope I can pass some of it on to all of you. So with that, let's get started. I want to give you one quick bit of insight. A lot of times when I show my trades or do presentations, I know that some of you are looking at the risk and looking at the entries and wondering, I don't know if I can do that. You know, when you have a lot of money under management, I manage money for four of the largest sovereign wealth funds in the world. Those are countries, and it's a gagging amount of money. I trade my own account. I traded in lockstep with them, but I asked them about the middle of last year if I can sometimes take positions, especially when I intraday trade or trade for shorter time periods than they're trading, that would reflect more to the audience I'm writing as well as the people I'm teaching. They're fine with that as long as their positions are reflected correctly. They don't really care. So we've uncoupled, if you will, when we need to. And today, the two trades that we're going to look at two exact trades. I'll show you where the portfolio entry is. So I have as a disclosure, I have an ongoing position in crude, but I'm going to show you two trades as well that look much more like what you would probably trade. Controlled risk, easy targets, take the money off the table, start again, a way to do it with options. And I think this will be more interesting for, well, it may not be more interesting. You might be, wow, I'd love to do that, but it'll be more practical, let's put it that way. So let's start looking at the crude oil markets. So this is 2009 all the way through March of 2011. And you can see prices just stair-stepping higher. We're making higher highs. Let me get my little ball here, so to speak. Where'd that rascal go? Where's my pointer? There we go. Prices stair-stepping higher, higher highs, higher lows, higher highs, higher lows. And it's the process, you can see. Then we leave a nice little shelf here, then break back out of it, higher highs, higher lows, higher highs, higher lows. I have nothing to do. I'm casually, at this point, it's later in the year. I'm backing up. These are daily bars in crude oil futures and just taking a look and saying, okay, how does this market act? What phase is this market in? It's clearly in what I would call a sustainable uptrend after a huge fall from 148. Now let's see if I can hone in on the current market and what can I do with it. And it takes patience, I think is the best way to say it, to trade these markets, especially if you're trading dailies, 240s, weeklies, monthlies. I trade weeklies and monthlies. But if you're stalking a trade for 2 years, a lot of people don't have the time, they don't have the patience, and they need more action. But for portfolio trading, a lot of times I'll stock trades for long, long periods of time, but I'll also hold those trades for that long period of time. So take a look. I'm just drawing the lines of force here, and all I'm doing is connecting his prior major swings. And you can see we've got a pretty strong line of force here, and you can see it gentle out as the trend matures a little bit. Now, those of you that are doing charts like this and looking at dailies, as we're starting to flatten out a bit, are you saying to yourself, hey, maybe this market is topped out and I should be thinking about a short position? Anybody get that feeling when you look at these types of charts? You want to have a dialogue with the market. It's okay to have that thought. It's okay to even draw on a median line or regular lines like this and say, you know, things are slowing down a little bit. And ask the market, you know, is it time? Is it time to get short? I don't see any signs of weakness. Well, let's see what we get out of this. Well, just about the time it looks like things are slowing down, what do we get? We get a wide range bar higher. We leave an open gap down below. And this is a sign of strength. This makes me sit up in my chair. We've taken out all the highs. We've closed above all the highs. And again, we've left the gap open. The longer this gap remains open, the stronger this market is. I'm still not ready to trade. At this point, I've rubbed the sleep out of my eyes. Even though these are dailies, I've knocked the rust off. Okay, I'm a little interested now. And lo and behold, we get some follow through. And you can see, look at the line of force. The line of force is even greater than earlier in the beginning. So there's some people that definitely got caught short here, that were picking the rounding top, decided to get short with a stop above the prior highs. They got filled on this day, the opening gap, and some of them are even breakout buyers, and for the next few days have filtered in, and it slowly continues to drag its way up, but it's a nice line of force. Me, I might be interested in getting long, but I think about it this way. All things have a balance in life. And we'll talk about that, that's Newtonian physics. And we'll likely come back into balance. Why, here's a pullback. Where do? We come back, we fill the gap, of course. Here's our first minor swing low, which came right before a gap. And remember, we talked about this last time. Gaps are actually two pivots, a high and a low. We've taken out this prior swing low right before the gap. And we've taken out another prior swing low, but these are small ones compared to, this is a major pivot in my opinion. This is a major pivot in my opinion. This now becomes a major swing high. The rest of them are swings, but they're not quite as major. Now, you should ask yourself, has the trend changed? Are you ready to get short this market? And again, you should have a dialogue with the market. What's the market telling me? If you don't have an answer, do some more analysis. Buy a few more bars. There's no hurry to get in. Take a look. This is where I consider to be the major support, right here. This is called a multi-pivot line. It's a fancy name for a trend line. 1, 2, 3 prior swing lows. All basically, anybody can draw this line. Sometimes people get caught up in drawing the sloping trend lines and they miss the horizontal trend lines. And a lot of times the horizontal trend lines, this is where, you know, I'm called a whale, and that's a nice term. That doesn't mean I'm a big fat guy, although I'm not the slimmest guy in the world. It means that I have big positions in a lot of the markets that I trade. I'm one of the larger traders. This is where the whales hang out, on these major multi-pivot lines, these major swing lows. To me, this is the line of no return. I don't want it to break this low. If we go through here, I've got to reevaluate everything, because that's the low after, excuse me, this swing, this line of force that came off of this swing high. We made the first pullback. Here's our first pullback. If we take that out, I've got to reevaluate the whole chart. But let's take a look up in here where we are. We came through the gap over here. We retested it. It offered great resistance. We had left a low before we retested it. We come up now and retest it from down below. It holds. We come back down, tap the prior low, tap it again, and we're right back up at the top of the gap. Now, I want you to everybody just remember this area right here. We'll talk about it later. Now let's take a look. If nothing has changed, this is the same chart. Let me go back and check. Here's this chart. All I'm going to do is take some lines off and show you something. Here's our multi-pivot line. Here's the gap. Everybody should be oriented now. Here's our major swing high, other than 148. Here's our major swing low. So let me mark out, if I'm playing what if in my mind, let me mark out the major pivots. Major swing low, major swing high, major swing low. We're retesting from the downside again the upper gap line. Now I could draw a median line from this first low down here. I could draw a median line from this one. Let me go back one slide, and you'll see that it's almost the same low. I guess you can't see it quite as clearly, but again, it taps the same line. Or I could draw it from the third one. I call this a width median line. I want to grab the widest and biggest swing on this entire cascade higher or stair step higher. So I'm going to go and use this as the A because it's the lowest low. This is my B pivot because it's the highest high. And this is my C pivot because it's the furthest in this swing. And it's not a new swing until we start, I'll try it again, until we start to take out prior swing highs. And we haven't taken any out yet. So I'm playing what if. And the reason why is because what median lines do is they have a mathematical probability. If you can identify A, B, and C, and there's a little art here because we haven't broken out, but once we break this out, these will be the easiest ABCs to identify. Once you identify the A, B, C, you have a mathematical probability projected forward of the probable path of price. And what happens is you find the center or bisect this B, C, and connect it with the A. That gives you the slope. You project it forward, and we have the probable path of price. Right now, though, if you think about it, what are we doing? We're regathering energy. Right now, this is an energy coil or a range or congestion. Price spent a lot of energy doing this, coming back up and testing it. Now we're resting. We're getting ready to either break above this gap line or come down and take out what I considered at the moment to be the C pivot. But we have to let price tell us. We should not project our opinions on price. Instead, we need to have a dialogue with price, pay attention to the language of price, and from there, we'll be able to find higher quality trades. Let me try and make it a little clearer here. If I think this is an uptrend, I'm a Newtonian. I actually have a degree in physics. And one of the major tenets of Sir Isaac Newton's laws is for every action, there's an equal and opposite reaction. So if I want to get long, I'm looking for price to pull back before it then moves up on the upside. There's a famous book that was written, anybody knows, 1500 BC to 5000 or 7000 BC. It depends on who you want to believe. It's called the Emerald Tablet. And Sir Isaac Newton has the best translation of it. He was an alchemist, for those of you that don't know, which was not a dirty word in those days. I guess today they're looked on as like tarot card readers. But as above, so below, which means equal and opposite reactions. And so you can see, if I'm measuring, it could have stopped here, straight below. Could have stopped here. You can see it could have stopped here. This could have been the stopping point. Maybe this is called hunting for C. Maybe this is the stopping point. But I'm looking for something in this area to be. It's almost like a rubber band being stretched back. To get to the end of the stretch back and then move back in the other direction. As above, so below. A pendulum pullback. Okay? And we're right at the gap zone. So price has now got to make a decision. I don't have to make a decision. Price has to make a decision. There's nothing for me to do here. I will never be a breakout buyer or a breakout seller. I'm going to buy a pullback, or if we break above here, I'll buy a pullback here. If we break below this area, then I'll be a seller here. And it all depends on money management. So let's see what price gives us from this particular area. First, let's look at the median line. So this is what the median line, I haven't changed anything. Again, take a look. 3 taps below, and I just drew in a median line. Now let's inspect the median line. Nice touch here. Nice. This is called the tail. Nice touch here. Lots of touches here. Nice touch here. This works okay for me. Too early to tell how we're going to play in this area. But all of these touches tell me that this median line has probably got some frequency, or is working with the same frequency as price. If I projected this, for example, this parallel backwards, you can see it does pretty well on these tops. You can do that in your mind's eye, or when you get the PDF afterwards, just take a ruler and a pen and draw it backwards. You'll see it catches these tops pretty well. And that would make this a center line. This would be the action line, and then flipping it over would be the reaction line. But this happens to be, at the moment, a median line. I'm not showing you action-reaction lines. We'll do that another day. So I'm just zooming in. And you can see we're flirting with taking out the upper gap line and multi-pivot line. And see how price came down and tapped it, moved back up, zoomed through it, came back up and tested it from below. And you should pay this close attention to your charts. And again, I'm not ready to trade. So I'm not doing this 15 minutes before the trade. This is a daily. When you do your analysis, you should be doing several hours of work on a commodity if you're going to put, lots of do-re-mi on the table. We've come back down. We're in the same area and bounce after being down there twice. And now the question is, what are we going to do at the upper gap line and the multi-pivot line? By taking this out, I don't mean 20 cents. We need to take it out. So, here's another way for you to frame this. We call this a change in behavior line. All I did was connect the the slopes as we were cascading lower. Look at, here's a prior top, here's another prior top, here's another prior top, here's another prior top. I connect this and go all the way down, and you can see my first tell, other than we've barely made a new low here, it's basically the same low, is when we take out this change in behavior line, I might scratch my chin and say, I wonder if we'll be able to take out this upper parallel and break out of the range. Odds are better now. That would make me want to know, because this is an energy coil from the upper gap line down to these prior lows. This is the energy coil. This is where price is refilling its gas tank. If it breaks out to the upside, it should ignite. like a rocket. Now, normally I would show you whale trades. And this is where the whales are playing down here. The whales don't move their orders up here, not yet. They want to trade close to the bone, as we say. And again, at the end we'll talk about this. But trading down here is fraught with danger, and the stops are a lot larger. The payoffs are much bigger. But for smaller accounts, especially when we're talking about an oil contract that's $1,000, a big figure, or a handle, or from 72 to 73, we need to control our risk. And we'll be talking about that today. That was Amos's specialty, risk reward. So let me show you some advanced drawing. We're just going to show you a peek at action-reaction lines. I don't do this often. There's a little bit more art involved in the action-reaction lines, although Alan Andrews made $450 million during the 1929 crash for Joseph Kennedy, which translated into today's terms is about $13 billion. So it's a nice take. But you need to know the technique fairly well, and the key is the center line. So let me show you how to develop one. But please, don't do this at home without lots of practice and lots of validation, and be honest with yourself. If it doesn't work for you, just throw it away. I've seen lots of students that did really well on median lines try and mimic what I do in action-reaction lines and not have good results. Remember, my results are not the same as yours. Your results are not the same as mine. Depends on your ability, depends on what you can see. Some people just have a natural affinity for them. Some people never get them, but they're great at median lines. So all I did was, this is the timing period in this box. That means that's where I trained it. All I did was I grabbed some lows. Major lows, major lows, major high, major lows, major lows. I don't want to use the whole thing because then I want to see how it reacts afterwards. So I'm going to just use this box right here as the training box. I connect these, this is a multi-pivot line. I connect these lows. Nothing too exciting. Then I change the color on you, sorry about that. I project it forward in space. What do I see? Does a pretty good job here grabbing bottoms. Overall, looks pretty good to me. Can I get some more confirmation? Well, how would we construct an action-reaction line from this? I go to the prior major low. I take that same slope. I project it forward. I'm just okay with it. It grabs some highs. It grabs some lows. You can see it left a lot here. But I'm not done yet. If I try, someone asked me why I'm not showing the whale trade at the same time. If I tried to do, you'll see as the presentation goes forward, if I tried to show you the whale trade and these other two trades, we'd be here 4 hours instead of, unfortunately, Cynthia winces when I'm here because I'm always here 2 hours. So I'll be glad to show you the whale trade another time or do an article and give it to Cynthia. So I measure the distance from the action line. This is the center line. Okay, I want to know the width. And remember, for every action, there's an equal and opposite reaction. And you'll see I can use this over and over and over. And this is just beginners action-reaction lines. There's also non-equidistant action-reaction lines, but these are the ones that are easiest to draw. I measure the distance from the center line to the action line. The action line, I'm going to use a major pivot. I take that same distance. I put it on top of the center line. Okay? Now I just take the same slope, take it off of the top of the same distance. Now I have my reaction line 1. Now I take a look at this. I like this. Look at the major call here. As we cascade lower, grab some bottoms. You can see them try and press through here, but they're unable to. None of these closes are below this line. Here's another one. They finally bust through it. Where does it go? Right to the center line. Now I'm liking the story that this action-reaction line is telling me. Once it gets to the center line, it runs right back up to the first reaction line and fails and heads back lower. As above, so below. What else can I do? Well, let's look. I can project the distance down another level and draw the same slope line. What does it give me? The exact bottom. This is where the whales play. Wouldn't you like to have known to be looking for this pivot long before it happened? Because remember, I trained it in this box. So if I draw 2 or 3 sets down below, I can be looking for this in advance. Wouldn't you like to know? Let's go to the next level up. Look at it catch the tops and bottoms, the next level up. But let's go up 2. Gee, this set of action-reaction lines, and again, I trained it right here. I didn't curve fit it all the way over here. This action had nothing to do with it. Wasn't even paying attention. I drew it long before this action happened. Next level, beautiful. What is the second level? So this is reaction line 2. This is reaction line 3. What does it give me? It gives me the top almost to the tick. Almost to the tick. So this action-reaction line set gave me a market map that gave me the top, the major reaction, the test at the gap line, the pullback, and when we cascaded lower, at least so far, it's given me the dead low to the tick. The maps don't get any prettier than this. And equidistant action-reaction lines are not particularly difficult to draw after you practice them a little bit. But please just don't draw 1 or 2 and then try and trade them. Draw hundreds, thousands. There are lots of articles at marketgeometry.com about action-reaction lines. It's all free. You're not trying to sell anything. We just want people to be well educated. Let's zoom back in. We'll leave our major median line, which is in blue, almost grayed out. And we'll pay attention. We did a smaller, I don't want to say inside median line because there actually is a different type of median line called inside median line, but a smaller median line that plays with the smaller pivots. Because this blue median line is so large, it takes a lot for us to get to the point to interact with it more than once. So we're more likely to interact with this green median line. And for those of you that are already, after 20 days, saying, oh my God, I hope I get a trade. And I get that a lot for people that are first making their move over to dailies from trading 20 minutes. 20 minutes doesn't work for me. I have to, whatever. And 240s, I don't really like those. Let me go to dailies. Well, that means sometimes you have to wait 20, 30 days for a setup if you have multiple, even if you're charting multiple things. But once you get in the rhythm of things, you're watching 3, 4, 5 things. You have something coming up, and then 20 days later something else will come up. But in the meantime, you're in a trade, so it doesn't seem quite so bad. But when you first start out, it can be it seems forever. So we know that both the action-reaction lines and the median line is telling us the probable path of price. Why do we know that? Well, the action-reaction line, we proved it. It grabbed the exact top. It grabbed the exact bottom. This is where the whales were playing. This is where my longer-term position is at right here. This median line itself, by its mathematical probability, is going to tell us the probable path of price from here. It's already built in. That's why Andrews invented median lines, so that mathematics from the first bar afterwards would have a mathematical probability. So let's take a look. Now that price is back above the action reaction line, or the action line, and is broken above the upper, so we're above the action line here, and we've broken above the upper gap multi-pivot line, I'm going to consider taking a long position in crude oil futures. And this is much more like a position that all of you would take, because it doesn't last 2, 3, 5, 6 months. If price pulls back to the area where price intersects with the upper gap median line right here, the upper gap horizontal multi-pivot line and the median line, I'm probably going to want to trade there. So let's take a look at what the trade would look like. Ideally, I'd like my stop to be under structure, which is a major swing low. Well, where's the major swing low? Unfortunately, the major swing low is all the way down here at 74 cents. So I don't get long at 86 with a $12 stop. If I have a $10,000 account, that's not going to work for me. That's going to be not only a margin call, but a call saying that your account's been closed. So I can't trade that. So we'll be realistic. And if we take a look at some of the inside bars, call this taking a look at noise. Take a look at this bar. Take a look at some of these bars. Take a look at these bars. When the market isn't popping out here and there, when it's just non-noise, this bar, the bars in this area, they work out to about $3. So I'm going to eyeball them. You can do it much more fancy. You can do an Excel spreadsheet and figure out bars that are wide range, bars that are normal size, and I'm going to use $3. Here's what I'm going to do. I'm going to buy at the confluence, at the upper gap horizontal multi-pivot line right here, which comes in at 89.75. I want to get long at 89.75, and I'm going to put my stop $3 below at 86.75. The majority of the people at Market Geometry that trade, especially when they trade a larger contract like this, if they're unable to get below structure, they're willing to use this type of stop. That's okay with me as long as it's outside the noise. You can't put a stop $1 underneath your entry in crude. You might as well just write out this check for $1,000. But if you actually take the time to look at these bars, the noise is about $3, so that's okay with me. Then, the next question I have to ask myself, and this question comes directly from Amos Hostetler. Amos is the first person of all the people that I've studied that took a look at risk-reward and where the curve starts to steepen. In other words, when the risk-reward number gets above X, where do you start to actually do better and better and better as a trader? And I'm just going to use a raw number. I'm going to say it's at 3 to 1. So I'm not going to take a trade that's worse than 3 to 1. So let's take a look. I'm going to get long at 89.75. I'm going to risk $3 to 86.75. Where's my profit target? On day one, I'm just going to go straight up to the upper parallel. Why? Dr. Andrews says the mathematical probabilities are that if you're at the median line and heading upward, you'll get to the upper parallel 80% of the time. Numerous studies have been done. I've done tens and tens of thousands of hours of studies on this, but other people have done exhaustive studies on this, as well as, of course, Dr. Andrews, Dr. Anderson, who was the head of mathematics at MIT, and many other. There's now actually some business schools like MIT. I've spoken at MIT. They've done some studies on it. University of Chicago, Stanford. There's lots of people that have done studies on this. Price makes it to its next most likely line, meaning from the median line to the upper parallel in this case, 80% of the time. So this is a nice logical place to take profits. It's also right below this prior major swing high. That's another reason to like this area. But this is just the very next day. Remember, if I have a position against an upsloping line and I'm long, this line is going to keep moving higher. The longer it takes for me to get to the upper parallel, the more money I'll put in the bank. Because let me say that again. This is an upsloping line. If I'm long against an upsloping line, the longer it takes to get to my profit target, the more money, if I'm smart enough to move my profit target, I will make. So on day one, I'm going to be at exactly at 3 to 1. So to me, this is the minimum acceptable risk for me. I'm risking $3, I'm going to make 9. I expect time or space, as price moves to the right, will eat up some of this area, and I expect we'll move up further unless we get a one-day zoom. Look, if I get filled the next day, if I get long here and fill the next day and make $9, that's $9,000 a contract, I'm a very happy camper. Give me the money, thank you, I'm gone. But if it takes 10 days or 15 days, look what happens to my profit target. It moves up, 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 and up, and I'll make more and more money. And the risk reward will look better and better, okay? But minimum, I'm going to start realistically, which is day one, it's 3 to 1. If it was less than 3 to 1, I'd have some considerations. And we'll talk about that. Let's see. Price comes up and tests the first reaction line, gets rejected, comes back down. If I had a really magnificent broker like IB, I'm sure I would have got filled at 89.75 on this bar right here. Every other broker probably wouldn't have got filled. So I leave my order in, and you can see price finally comes down about 6 bars later, and right at where, look where time and space meet perfectly, or time and price, you can say it either way, right at the energy point, which is what that's called. I get filled. I'm long at 89.75. You can't see it that well. You can see it when you get your slides better. Price closes right around here. So right on day one, I've got a little bit of profit, but you know, there's nothing to write home about. We have lower highs. So far, the upper gap line is holding. I'm long. The first thing I do when I find out that I'm long is check to make sure that my initial stop loss order is in. Okay? I don't do anything until I do that because I want to be protected. I put both orders in the market at the same time and leave them in. But once the long is filled, my limit buy, I check to make sure that my stop is there and working for the same amount of contracts. I don't want risk that I haven't anticipated. I want to be protected. If I get stopped out, that's fine with me. But I don't want to be down here saying, oh my God, I forgot to put in a stop. Now what do I do? No. If it breaks through here, just take me out. It's fine. Then I can put in my profit target. Now I've got a couple choices here. You notice this was my original profit target over here at 98.75. Now my profit target is at 99.90. So is it up a lot? No, but it's up more than $1. That's more than $1,000 a contract. So my risk reward is improving. But I've got to take the time to measure where price intersects with the upper parallel at the end of each day, and then on my platform, change my order. Now, my broker, IB of course, allows me to do what? I can tie this profit order with this stop so that if one fills, the other one gets canceled. But even so, if one was filled, I would still check to make sure. Little details. It's hard enough to make money. You don't want to lose money on little details. When price comes up and makes a new high, it takes out the prior swing high at 94.75, I was risking $3. Now I've got $5 in the bank. Potentially I had almost 6 and change. I've got a smaller account. Let's say I've got $10,000 or $20,000 or $30,000. I'm going to go to break even. Comes back, shouldn't come back down here now. It's made a new high. Andrew says it should be 80% probability. It should be going to the upper parallel. It has no business coming back down below the median line and back to the upper gap line. So I'm going to go to break even. But I'm going to wait for this high to get taken out for some more new buyers to show up. That's a sign for me that there are new buyers in the market. So now I go to break even. And you can see, it doesn't take too long. I like the sustainable move with the small bars, but then all of a sudden we scoot higher. And I'm always a little bit nervous when I'm in a shorter time frame position and my stop is relatively close to the market. When we go vertical, because we've shown geometry that when the market goes vertical, you can't, and I'm not saying you should go short there, but if you're long, you should tighten up your risk, because your risk control, because more vertical markets tend to stop and turn vertically. So be careful. Don't do the happy dance when a market goes vertical. Instead, you should be saying, am I near my profit target, or am I at least able to tighten up my profit floor, something like that. In this case, price went right to my profit target at 102.25. I'm out. If it keeps going, God bless those of you that are long. That's okay with me. I got my piece. And by the way, for those of you that were curious about options, let me roll back a couple here. You could have gotten long here. Again, don't quote me as Mr. Joe Option. At one point I ran, or they reported to me, Chicago Research and Trading, which was the largest options house in the world, they reported to me for about 2.5 years. And for the first 6 months, I can't tell you how many multi-billion-dollar positions I took in options instead of taking them in futures or cash. And I think the people that were on the other side of my position at CRT made more money off of me, because it was always something like, you know, you got the move right, but the volatility was wrong, because we were doing things like down and outs and all these other strange things. They'd propose all these different ways to exhibit risk. So for me, I'm a very simple-minded trader. I like to do it in outrights, futures or cash, period. But that doesn't mean as an option trader you can't. I recently mentored somebody who's actually the president of a very large stock firm, and he makes multi-million dollars a year now. He was having a tough run, came and got mentored for a year. He said last year he made multi-million dollars in his account, does nothing but options. A little more savvy about options than I am, but he does fairly simple things. Here, you could do this. Get long here and just sell a call at 99.5. Price gets up there. You've already taken in some premium. Price gets up there, you get taken out. It's not as profitable, but it's a lot safer. There's other ways you could do spreads, but that's for the people that are a little wiser than me. But I'll mention that again when we get up there. So price takes me out at 102.25. Look at my risk-reward ratio. It started out at 3-to-1. Now it's 4.17-to-1. There's something funny that happens just below 3-to-1. Your ability to grow an account goes up almost geometrically with each tenth that you are able to reap. This 4.7, 3.1, 3.2, 3.3, 3.4. If your average risk-reward ratio that you actually booked on a trade goes up and up and up, your ability to grow an account goes up dramatically. This is another, again, one of the core teachings of Amos. These teachings have been lost. Amos never wrote anything. There's a little bitty book out there, but Amos didn't write it. Somebody, Morge Moskowitz, wrote it, but Amos didn't write anything, unfortunately. His son made a fortune owning Cablevision, but isn't a trader, never was a trader, and is not interested in trading. So let's take a look and see at the current action. You can see where I got out. And what did I say? When price tends to go vertical, it tends to pull back in a vertical fashion. Look what price did. Went up to the upper median line parallel, which is where median line theory says price should run out of energy. and fell back vertically. Where did it stop? At the first reaction line, like a charm. Price pulls back. Now look, it does not make a new high. It does not make it to the upper parallel. Has this market changed directions yet? Here's the gap line. Here's the prior two major swing lows. This is the whale line. I think price is pulling back, but I think it's because everybody got all excited when we took out this high and jumped in and had to get long, and now they're watching their profits slip away, so they're booking profits. So as a trader, personally, I think we're still in an uptrend. All these lines are doing exactly, price is doing exactly what these lines say they will do. Look at price stop at this upper parallel. Look at it stop at the first reaction line. Now we've zoomed through this reaction line, and we've also zoomed through the median line. What does Andrew say? Andrew says there might be a test here from the downside of this median line, but if we make any headway to the downside, we're going to this lower parallel with an 80% probability. So as a trader, I don't want to do anything here. I don't want to get short. I think this is still in an uptrend. But I've booked my profits. And think about it this way. Let me go back one slide. I've rolled forward 4.17 stops. So I can be long more than 4 times and still be playing with the market's money. So I can breathe a little easier. There's no pressure to trade. And when I trade, I don't have to worry about it. If I use the same size stop, I can be wrong and I'll still have 3 chances at it without breathing hard, or 2 chances. It's all about rolling forward stops. So let's take a look. We crack the prior swing low, and where are we likely headed? We're likely headed right here to the lower parallel. And wouldn't this be a great place to get long? It's got everything going for it. Take a look at it. This is the upper gap line. You can see the test here. You can see the pullback to it and the median line right here. It stopped at the upper parallel. You can see it zoom through the median line. It looks like all these lines are just singing and talking to you. Wouldn't this be a great place to get long? Okay, I'm willing to get long there, but oh, darn it. See, price doesn't always give you what you want. Price came down, found buyers before it got to an area that I was willing to play, and headed higher. Now we've zoomed the median line, and we're kind of flirting with it. We actually don't make a new high, or we make double tops perhaps, and then we turn back lower. And you can see us bouncing and bouncing and bouncing off this first reaction line. So the lines are still doing what they're supposed to be doing. I'm kind of bummed about not being filled here. I wanted to get long here. The price took off without me. So if price comes anywhere near this lower parallel, even though it's at a higher area, I'm going to be a little more aggressive with my orders and work them just inside this line. I don't want to be left at the altar, so to speak. It may never get there. It may never go below this first reaction line. But if it does, we have a member named Carlos, and he has a famous saying, trade within your stop. I'm willing to trade within my stop, meaning I'm willing to go inside of the lower parallel and then trail my stop underneath it. So let's see if we get any sign that price is going to do anything for me. Well, it's flirting with that area. And what do? I put an order in, and you can see it test the line that I drew a few times. And then I finally put an order in and I say, look, I want to get long at 96.00. Where's my stop going to be? This time I'm actually going to use real structure, which is this prior swing low. There seemed to be a lot of buyers at this prior swing low. It turned on a dime. So I'm going to put my stop just below this prior swing low. And it's still reachable if you've got, you know, a smaller account, which is the whole idea of this exercise. It's $3.50. It's just a little bit larger than I used before. So my stop is going to be underneath a major swing low. Here's a swing high. Here's a swing low. It's at 92.50. I'm just below that. And lo and behold, I get a wide range bar that comes down and fills me. I probably would have got filled if I was with IB on one of these bars, but this one I get filled at 92.50. Should be 96. I have my stop in already, and I double check that my stop is live and in the market at 92.50, so I'm risking $3.50. Now, where's my logical profit target? Well, it worked pretty well last time. Let's play again. When price comes off the lower parallel and heads higher, Andrew says with 80% probability it's going to the median line this time. So I'm just going to measure straight up. My target's at 105.75-ish. Okay, it doesn't have to be rocket science because the chances of it hitting the next line are not that good. 105.75, and I'm going to move this as you saw before, as space goes forward. Or you could also do I believe it's called a covered right. You could be long the physical and sell a call up in here. Another way to do it. Now, I'm going to take a look at this. Let me see, did I do risk reward on that one? Yeah. Can I take this trade? Risking $3.50 to make $9.75. $9.75 sounds pretty good, doesn't it? But that's an initial risk reward of only 2.79 to 1. Can I take that trade? Why would I take that trade? Well, let's look. It's likely that price is going to have to chew up some space or move to the right before we make this amount of upside movement. So let's say that it goes right up into this area, which is another confluence area or energy point, and it's not very far if you look at it. Look at the width of the swings. Let's just take a look at this swing and project it here, and you can see it's about the same. If I do that, now my limit sell would be at 108.50, and that would certainly make the 3 to 1 rule. So a little bit of thinking involved there. If you just do the raw planning and see if it hits it on day one, it's 2.79. It doesn't take much forethought to say, look, by the time it eats up 4, 5, 6 bars, I'm well above 3 to 1. You have to be realistic. You can't just say, well, why not put it up here? Because it's not realistic. But you can say that after 3, 4, or 5 bars, we'll have eaten up some space. And by the way, price would now be up here, and now the risk reward makes a lot of sense. So think ahead. And let's take a look and see what happened. Sure enough, I get filled at 108.50 on my limit sell order. You can see price gap higher, sign of strength. I'm right at the confluence of the second reaction line, reaction 1, reaction 2, and the median line. I was long at 96. I cancel. My platform automatically cancels my order, my stop loss order at 92.50. I never even got a chance to go to break even because, look, there was never anything to hide underneath. I might have considered underneath the gap, but that's so close to the action that really there's no, to me, there's no protection here. There's no reason. I'll just let it do its thing. And as you can see, it went nearly vertical. When it goes nearly vertical, I want to be out of the way anyway. So I capture, oops, sorry, one more time. I risked $350 and made $12.50. So my actual risk reward was 3.6 to 1. More than acceptable. When you get to portfolio trades, in fact, we did one live yesterday in the market geometry live session that was more than 10 to 1 in 240 crude. Took profits yesterday live. So you want to get above 3 to 1. If you get above 3 to 1 in risk rewards, it covers all kinds of sins. It doesn't mean you should trade sloppy, but it means, and we proved this in our last live seminar, which was last Saturday. We actually went through hundreds and hundreds of iterations of random sampled trades and showed that if you trade at, for example, 2 to 1, it's very difficult to be profitable. And for those people that think that you can scalp at 1 to 1, even though you're a good trader, it's not happening. It's just not going to happen. It's not going to work for you. If you take a look at the numbers long term, you won't be trading. When you get up around 3 to 1 and above 3 to 1, it becomes easier and easier and easier to be a consistent trader. And that's the message from Amos, one of the messages. Now, I was going to show you, I was going to show several things, but one of the things I was going to show you was, this was a long trade in Canada that we stalked live, and you might ask, what's that got to do with gold? And I'm going to leave this as homework for all of you, but I'll give you 2 slides to consider. Canada produces more than 3 times as much energy as it consumes. Therefore, it has capital flows back into the country when the price of oil goes up. So when the price of oil goes up, the Canadian dollar goes up. And right about the time that I was stalking this long position, and I'm talking about the whale long position at 74 bucks, Canada had come back down, and we were looking at this trade live at the market geometry live sessions, which are 3 times a week, and took this Canada trade live right at the same time that I was getting long oil. Price had done its first pullback, and it headed back higher. Here's another example, which is even cooler. Now again, this is Canada yen. And right at the same time that I was considering my oil position, where's Canada yen? Now, if you overlay oil on top of this chart, this is oil going to $48 right here. Now, why does it work this way? Because Canada produces 3 times as much energy, and Japan produces no energy to export. So it's a wonderful cross to look at when you're looking at oil trades. So if you look at the pullback, where are we? We're right at the, we call this the press zone, or the area that you want to start looking to get long. We're right there. Right at the time that I'm getting long at 74 bucks, Canada yen is right where it should be and right about to take off to the upside. And of course it does. So I'll let you do the homework. You go ahead when you get the handouts, take this home, pull up your charting machine, take a look at Canada yen at the same time, take a look at the Canada dollar, and you'll see they coincide perfectly with the turn in crude oil. The long-term turn at $74, $75. I'm ready for questions. Cynthia there? Looks
yes,
like
I am, Tim.
It
takes an extra minute to actually... Tim, can you hear me?
I can, darling. Can you hear me?
Oh, okay. All right. While I'm going to give you a moment to read questions, some questions
Okay.
did come through, and I do want to invite everyone, if you do have questions or comments, go ahead and enter it into the chat panel. But I do have one piece of business to do right now, and that's run the poll. Tim will be back to answer questions momentarily. Now, IB's management requires that I do this in each event, so I do ask you to make your selections. There are 3 short questions there, but also notice there's an input field. If you do have any comments, don't put your questions here. Put the questions will go in the chat panel. But I do ask that you do this and then make sure that you click the submit button, because I do review this with management on a weekly basis. So, and if you've got comments or topics that you might like to hear more about, that's an excellent place to put, or that input field is an excellent place to put it, because management will see this at the end of each week. Now also, for those of you who are having audio difficulties, I do apologize. Poll has ended, by the way, everyone. Thank you very much. If you did have audio difficulties, sorry about that, but do be aware that we are recording today's event, and you'll all get access to that recorded playback. So if you happen to miss a brief portion of the event, or even if you want to come back and review the concepts along with your copy of the slides so that you can study them for your homework, please be aware that you'll be getting that link as you exit today's session, or watch your email for a direct link to today's recorded playback. By the way, everyone, you can simply close out of that polling panel using the X that's provided in the title bar. You'll find the chat panel title bar. Double-clicking that will reopen it so that you can send any comments or questions. Tim, back to you. If you see some questions you'd like to start taking, go right ahead.
My first comment to everybody, if your sound was going in and out, relax. An hour or 2 from now, Cynthia will send you this wonderful link. At your leisure, you can go back and listen, and the sound will be perfect. The video will be perfect, and you can just relax and watch it over and over and over. And you won't be able to submit questions, but you can always email us. That's easy. And if you email Cynthia, she'll send them to me. If you email me, I'll answer them, vice versa. So don't worry about that. If you missed a little bit here or there, just go back and rewatch it. And I suggest you rewatch it anyway. Repetition is the best way to learn. Let me go back and grab some questions here. One of the easiest ones for me to answer is, did I look at logarithmic scales or normalized data? I don't look at logarithmic. I've looked at them, but I don't look at logarithmic. I would have to be looking at dailies that go back 20 years for me to even think about using logarithmic scales. It works fine on logarithmic scales, but there's no need to use them. It just flattens out the action too much. Do I analyze? Here's another one. Do I analyze higher time frames before entering a time frame of interest? This is not going to be a popular answer, and I don't mean to anger anybody else that also has a doctorate in front of their names. I don't use mine, but I think there's been a great disservice done to most traders telling them that they have to look at multiple time frames, because there's enough work if they just pay attention to the one time frame that they're trading. Everything that you need is on the time frame that you're trading. Am I going up or down in time frame? All you're going to do is A, confuse yourself, and B, do extra work. Just pick the time frame that you're comfortable trading. Trade that time frame. Don't look for confirmation. If you're trading the dailies, don't look for monthlies. Don't look for weeklies. And for whatever you do, don't go down to the 20-minute to try and fine-tune your entry, because the volatilities are different on each one of these. So if you're going to trade dailies, just trade dailies. Just look at dailies. Don't even go there. Which period do I normally trade? Well, if I'm trading for my sovereign wealth funds as well as myself in portfolios, I trade dailies and weeklies, no doubt about it. But those trades often last 6 months, 13 months, a long time. I got long oil at 35.50 and got out at 114 and 93 were the 2 exits. But that took forever. I also got short at 148, almost the top, about 40 cents from the top. That was a tip from my son, by the way, who was helping me chart, and rode it almost all the way down. I did a Chicago Board of Trade presentation, and Cynthia, I think that's the first one I ever did with Cynthia, and we did this was a CME CBOT type of thing, and we did a cross-currency trade to represent something else, and that trade went on, and we updated it live every 2 weeks on the CBOT for 14 months before we finally took profits. So I use both. Do I use fibs? You don't have to talk to me privately. Just pop it out there, by the way. Just say to all participants so everybody can read it. I want to know where the fib levels are, not because I'm going to trade it, but because I want to know where all the fib orders are. Because if you stack up, I'm a good friend of Joe DiNapoli. He's probably the best fib trader in the world, as well as Carolyn Borden, also another good fib trader. You know, I want to know where all those fib orders are at. Sometimes I'm going to, you know, if I'm a whale and I'm washing and rinsing out an area, which means I'm pushing the stops, I'll want to know where the fibs are because I'm going to run those orders. So I want to know where they are. I can't give you a Tom Selznick. Somebody wants to know who should they see about options. Tom Selznick, who used to own the Thinkorswim, but I mean, I don't know that many people that are available that I could point to. How about that? That doesn't mean there aren't good people out there. I would only send you to somebody that I know personally. So, sorry, I don't. How many instruments do you advise people who work full-time who trade dailies to watch? You know, you have a lot. If you're watching dailies, you have lots of time, so you can watch a good 10, 15 markets. And I would throw, by the way, I wouldn't mind throwing some stocks in there as well. I'm kind of off ETFs. I don't really like ETFs. They're not transparent enough to me. If you don't know what that means, don't worry about it. But you know, I wouldn't go overboard. What I would like is a good coverage. I'd like a couple grains. I'd like oil. I'd like gold. I'd like probably three currency pairs, something like that. And then I'd be in pretty good shape, and maybe I'd throw in a stock or two. Can this method be used intraday on futures? Hi, Greg. Yeah, and again, this method works on, here's Dr. Andrews' exact word, any instrument that fluctuates. In fact, he had a contest with the weatherman at the Miami Herald for 2 years. So anything that fluctuates, anything that you can chart that fluctuates, and I've done it on baseball team scores and predicted, you know, average number of runs per inning, all kinds of interesting stuff. We've done it on unemployment. We've done it on all kinds of things, and it works beautifully. So anything that fluctuates. So yes, and there's a time frame. It doesn't matter. Can I comment on Ensign software? Is it my primary charting software recommendation for my trading approach? I think it's the easiest software out there to learn. And so many people at Market Geometry use it that I use it and we present on it. And Cynthia, you know, I should say, IB just recently rebuilt that platform, and I'm going to be working with Cynthia to try and get more and better drawing tools on the IB platform, because nothing would make me happier than to put the platform up and be able to just draw away live instead of, you know, using a different platform. And I'm sure we'll get there because that's how good they are. Do I believe in time and price symmetry? I just showed it to you. I don't think it's the end all and be all, because it's very difficult, especially when you first start out, to nail it correctly, because when you start to get into time and price symmetry, you know, the stuff like I don't know, there's the Allen method, there's the Pira point and all that stuff. There's just too many points, okay? And there's way too much art involved, and way too many. It could have been this, but now it's this, and instead it's this, and so I don't go into that type of thing. But time and price often will help you find, once you learn to chart naturally, time and price will actually play right into your hands. But I wouldn't overplay that option early. In other words, I wouldn't just go right to say, oh, you know what, here's time and price, let me just make this the end all and be all. Instead, I just get involved in understanding market structure, understanding trends. Then I would find a nice tool that gives me a probable path of price, which is median lines. The most important thing then is money management and risk reward. It doesn't matter what PhDs I hold. They're all from the University of Chicago. What matters is, do you think I can teach trading, and is this methodology look interesting? We're here to make money. My PhDs don't make me any money. How do I isolate the areas to do the training for action-reaction analysis? I actually just pick those at random. What I do is I figure out, for example, if I'm trading a 20-minute currency chart, which a lot of you probably trade, I'll probably roll back about 3 or 4 days, no more than 5. I probably want in that 3 or 4 or 5 days, I want the largest swing or the biggest reaction, something that makes me sit up and pay attention. And that's all the data I need. Too many people squish in too much data into a chart. If you're going to trade a 20-minute chart, you don't need more than 3 or 4 days of data. You really don't. And then inside of that, I just take a little bit that grabs my eye and says, hey, you know what? This is a pretty good looking area that's got tops and bottoms. And I'll put in the box, and then I'll train it, and I'll do exactly as I showed you earlier in the presentation. It's not that hard. There's nothing magic about it. I know people think this is all very magic, but basically, especially when you draw median lines, if you just use the major highs and major lows, you'll catch 90% of the entries and 90% of the moves. Since I'm a whale, don't you most often pick off stops set below the recent high or low? What else can one do with stops? I think that's what you're saying, Greg. It's not that easy because, look, I might want to push through areas of support or resistance, but one of my buddies might be sitting right there. And what will happen is I might start to sell, and I'll get a phone call, and it'll be one of my buddies. One is, by the way, his name is Jamie, who used to work for me. Well, hey, what are you doing? Well, we talk. We chatter just like everybody else. But you can tell. One of the things we teach at Market Geometry is you don't have to be a whale. All you have to do is understand by the way price looks that there's a whale in the, playing. There's a whale feeding, and you don't want to be guppy food. It's easy. The signatures are there. You can actually tell. After you get good at it, you can actually pick out different whales. You may not know their names, but you can say this is whale A, this is whale B, and this is whale C. Oh, look, whale C is trying to buy here. It becomes pretty easy after a while. So once you know what to look for, it's actually not that hard. And as a whale, it's very easy to see it. And you're starting to sell, and you run into another one. Well, you know what? Maybe I don't want to try and run these stops, because my idea is not to sell to get short at that point, Greg. My idea would be to sell to then force you to sell, and then I'd take your position and get long, right? So is this good for Forex? This is great for foreign exchange. This is how I made all my money in foreign exchange for 30 years. It's magnificent. CME futures in foreign exchange, I traded a third of the volume for at least 15 years. How about that? Will I give a webinar devoted to whaleology? Cynthia, I believe we're about to start. You correct me if I'm wrong. I believe the next seminar actually is tied to the Futures University, and it dictates which instrument I'm going to teach, but that doesn't mean I can't show some whale tracks, right?
Oh, absolutely. And what Tim is referring to is that we actually do have, in conjunction with the CME, a School of Futures, which each month will be discussing different aspects of futures contracts. And then Tim will follow up 2 weeks later with some additional information on the contracts that we've discussed. Now, these are coming up. The School of Futures is the 4th Thursday of each month. But don't forget, the 2nd Thursday of each month, Tim will be back with us to discuss or for additional presentations. And if you want to add more, Tim, I think we'd all welcome that as well. So definitely. Thank you, Tim.
Oh, great. So I will definitely do one. I'll target one on reading whale tracks based on one of the futures contracts that they just talked about in Futures University. Okay, so we'll come back and do one of those. That's a great question, Greg. I just got a private message from I'm in a group. I'm called one of the Coral Gables members. We're the original students of Dr. Andrews. There's only 8 of us left. I see it's always great to see you. Thank you so much. And mom and kids give you a hug and kiss, by the way. And always good to see you. So there aren't many of us left, but you know what? I'm glad you think Dr. Andrews is proud, and I don't want him to spin him in his grave. I want him to be a happy man. I just want to keep it. I just want to keep his work alive. So I offer a daily live service. I'm thick-headed and need it constantly. What we offer. Listen, we never tout trades. Here's what we think. We think it's better to empower you. That's a political buzzword, I guess. In other words, we want to teach you how to trade. Because I'm not there to hold your hand. An hour afterwards, if I change my mind and I'm going the other way, you won't know it, and you'll be somewhere else. So instead, what we do is 3 times a week, we teach we say an hour and a half, but it generally goes about 2 hours, and we work from basic all the way to super advanced, and we teach everything from Amos to Dr. Andrews to the little twists that I have, as well as my partner Shane, and it's really magnificent learning. And there's also now about 2,000 hours of archived video there. So, and you can go get a real inexpensive 1-month trial there. You can also see a lot of it free if you go to Market Geometry. And there's a bunch of YouTube examples. And if you decide you don't want to spend any money, there's lots of articles too. And we also point you at Market Geometry to all the IB archived. This one will go up as soon as Cynthia sends me the link in about 2 hours. This one will be on the website. So there's already 8, so there'll be 9 going back 9 IB webcasts. So there's all kinds of free stuff to go take a look at. Let's see. I don't know what Tunde's question is. Doug. Hi, Doug, by the way. I'm reading backwards, which is kind of hard to do, so just bear with me here.
Actually, Tunde just put it back in, so it's right at the bottom of the chat panel.
Thank you. In one of your articles on Median Line website, you mentioned that taking time out of the charts helps filter noise. Do you advise us to bother with this for daily time frame traders? For dailies, no, I don't think it's necessary in any way, shape, or form, unless you want to do something like point and figure. You could do point and figure and use median lines on point and figure. I have a very close friend. I'm not going to name him. That's a multi-billionaire, all made from trading, all doing one thing. Point and figure with median lines, nothing else. And a magnificent trader, just absolutely sterling. Let's see, what else? What 3 pairs are you trading? Are they behaving better with the Andrews Forks? Well, they all behave well. Here's what you do, Jack, and he's talking about 3 currency pairs. You want to do 3. I recommend, if you're just starting out, or if you're not consistently profitable yet, no more than 5 instruments, because you want to be intimate with what you're trading. That allows you to have enough instruments that if something's not moving, just don't pay attention to it until it starts to move. Okay. If it starts to get into an energy coil and it's not doing much, pay attention to the ones that aren't in the energy coils and are starting to perk up. Once you start to hunt a trade, pay attention to that particular chart and turn the other ones off. Okay, and so I would say, for example, here's some good pairs. I love Canada. Why? Not that many people trade it. It's very, very deep now. I believe, I'm going to quote this, and hopefully Mark's not going to get mad at me because I get the number right. I believe he said that they do $11 billion a day, and this would have been Dave that said it, at the last webcast, $11 billion a day in Canada on a regular basis, and some days it spikes up to 20. So it's a very, very liquid, first of all. But second of all, besides moving, it has real physical flows. That's people that have bought oil, and they have to move the cash into Canada. Or it's Canadians that have got the money from selling oil, and now they want to invest it elsewhere. So there's real flows. So I like that. Another one is that people don't trade that much is the Aussie dollar, which is also very high on the liquidity list now. And why? Well, they have lots of metal and lots of metals, and all kinds of people, emerging countries, India, China, they have to buy metal. So when they buy metals, they have to buy them from the people that sell metals. The United States doesn't sell much of their metals, they use most of it. But Australia is a great place. They have real physical flows. I like that. The yen is just okay for me. I like it on a cross basis. If you're going to watch yen, I would watch either Euro yen or Canada yen. But that's just me. The euro dollar. Look, the euro foreign exchange. Not to confuse it with euro interest rate dollar. That's the big boy. That's the mini S&P of currencies. So a lot of people would do that. Mexico. I used to trade a lot of Mexican pesos in the early days. You know, people used to actually get obliterated on bad days. I don't trade it that much. I used to trade Mexican debt, but you know, it's not quite liquid enough for what I do. But you know, you can look at it. Let's see. Well, John, you can email me with that idea. How about that? And I can make some suggestions. How about that? Maybe we can do something on market geometry and facilitate it. Let's see. I'm going to. Gina says, "What are some of the signs of a whale in the water?" I'll tell you what. I'm going to do a. There are a couple articles already on market geometry, Gina. If you haven't gone there, look at the article section under free info. There's a couple articles about whales. Go take a look at that. But I'll try and put together a webcast for IB that's specifically we'll go hunt whales. How about that? So come back and hunt whales with me. Are there any other books on median lines which I'd recommend? No, absolutely not. You can read mine. That's okay. I think here's my personal opinion, and I have a book out. If I had to choose between buying my book or taking a month of trial membership of live sessions, which is less expensive than my book, I'd take a month of live sessions, personally. You might come back and buy the book, and that's fine. But I think you'll learn more from the live sessions. That's my personal opinion. Ahmad says, he's been using my stuff for 4 years. Oh, great. The 20% or so trades that do not work would work if moving averages confirm the upper median line or lower median line or MLH. Any comments? Okay. As long as it works for you, that's fine. There was a gentleman, the name has gone right through my mind at the moment, in 1965, around the time Dr. Hagopian was around, Dr. Andrews, that had a service that used not only moving averages but center lines, and shame on people like Mr. Bullinger and Manning Stoller and some of the other people, although Manning Stoller admits it, so I give him credit for not giving people attribution. This gentleman invented moving averages around the center moving averages, so with a percentage on the inside and outside, and then everybody else. And all those people that I named, by the way, went through Andrew's course. They basically just ripped it and pocketed the money. At least give the guys attribution. He's long passed away. What's wrong with just saying this guy invented this and thank you very much? Let's see, what else do we have? Time and price symmetry, I did that. In a long-term, daily, weekly trade, how do I roll my contracts? That's a great question, Nancy. If you're trading lots of contracts, and I trade lots and lots and lots of contracts. I'm not going to name them out, but it's a lot. You don't want to get eaten up by rolls. So you either have to be very adept at knowing, because things move in and out, based on the seasons. But so here's a perfect example. Currently I'm in a bean trade, soybeans, and I'm long November soybeans, November of 2013. Well, I'm sorry, November 2012. So the end of this year. And the reason I'm in November is because that's the speculative contract. Okay, the crops don't go into the ground in soybeans until after corn is in the ground, so it's usually in June or later. So the real move, the big moves, come when the crop is being planted and when it first starts to move to maturity. So rather than by May or July, I go all the way out to the speculative month where all the big speculators are, and that happens to be Novi beans. December corn is for example, the corn contract. So in oil, the roll is is pretty nothing. It's almost a non-event. What I tell my broker in oil is he knows my position. When it's time to move it out, just take your time to move it out. It's called DRT, giving him discretion. I don't even think about it. There aren't that many games played in oil in terms of the roll, but in terms of grains and stuff, there's lots of games played. So it depends on what you're trading. But the best thing you can do if you're going to trade long-term, Nancy, is get a good relationship with your broker and ask them, where should I be playing? So let's say there's 3 weeks before first notice. Is that enough time for me? Well, if you're trading daily, it probably isn't. You need to be out at the next contract with the most volume. So it all depends on how far out you're gonna play. Let's see. A lot of fibs. Same person with a lot of fib questions. Yes, and IB is already working on implementing median lines and modified shift median lines. Cynthia and I will make it happen. Don't worry. Who wrote the book about Amos? You can't buy it anyway. It's out of print, but it's only, Kathy, it's only 55 pages long, and actually we're about to just put it up at Market Geometry Free. Don't go chasing it on some rare book site because there's nothing in it. It's basically just a story about Amos. It really doesn't give you any trading information. So don't worry about it. What's the lowest time frame you use this stuff on? I don't trade much below 20 minutes, but my partner Shane trades 5-minute E-mini S&Ps all the time, and we have people that trade 3 minutes, 7 minute. You can trade on. I had a partner in a prop room that traded 10 tick E-mini S&Ps. You can go down as low as you want to go. Somebody was really trying to get a hold of me. I wish they'd just go away. Let's see. I would point out something that Cynthia, that somebody on my website or a number of people on my website said as well. They would like to ask you to make the polls last longer than 45 seconds.
Well, Tim, I always try, and I hate to interrupt the session for those polls, but let me let you know that you can always send me comments or suggestions to webinars@interactivebrokers.com. I don't want to take any more time away from your presentations than I absolutely must, but please know that I'm happy to accept any of those suggestions. Again, it's webinars@interactivebrokers.com.
And let me come right back at you and give you this. Anything that you send to IB, the Interactive Brokers, mention Cynthia and webcasts or webinars, because that tells management how much you appreciate the high quality education she puts together, and it gives her obviously more power to do more. So if any email you send, give her the nice mojo, because it really helps a lot. You'd be shocked how much it helps, I'm sure.
Well, thank you very much for that, Tim. But I also want to make a suggestion here, too. To current IB clients, we do have a new features poll, and it's underneath the About IB menu. If you are interested in adding those median lines, simply make the suggestion in the new features poll. That will definitely get the attention of our development team and hopefully be able to have them considering adding the information onto the platform. But I'd also like to tell Trader Workstation users there is a feature within our real-time charts that once you draw one of those trend lines within the chart, a simple right-click will allow you to create a parallel trend line that you can then use for those median lines as well. So until we do get the median lines and the pitchforks available in the platform, just be aware a simple right-click will allow you to create those parallel lines and at least get started.
You know what, Cynthia? Remind me before the next one or the one after that, and I'll actually draw one on the IBM platform, step by step by step. It's very simple to do.
Ah, excellent.
It's very simple to do.
We may even record that.
No, I mean, look, for the longest time, I started doing stuff on the internet in 1995. We didn't have any charts that did anything until 2001 or 2002, so we had to always do that. It's not that hard.
Oh, excellent. Okay. I see Charles is asking on what study. Actually, Charles, there is an edit chart selection that will allow you to freehand draw a trend line. But as soon as you do that, simply right-click on that trend line, and in the floating menu that pops up, you'll see create a parallel line. So that's how you would begin to construct those pitchforks, at least on our charting package. And we'll get Tim to actually show us how. So thanks, Tim. Love that suggestion.
No, I'd love to do it. A couple of people have asked me privately, and there's one publicly that want me to comment on some other people. There's no point in me commenting on other people. You know, this is what I do. It works for me. You know, if they do something that works for them and they're able to teach it and it works for you, I just want people to make money, to get good education and make money. I have no problem with anybody teaching their material, as you know, as long as it actually can make money for the people that learn it from it. That's the most important thing. You know, I was lucky enough to be mentored by some of the greatest traders in the 20th century, period. And I believe I owe it to them to pass it on and not let this material disappear. That's why I'm willing to teach. I don't know what other people's motivations are. I don't really care. But if they teach and they teach it well, I'm all for that. That's all I have to say about that. Let's see. Do I like consulting opinions when making decisions? Let me tell you how my day goes. I get up at 5:30 in the morning. I'm second in the bathroom. My wife's first because she has to get the kids up. My wife comes out of the bathroom. I go into the bathroom. I wipe the sleep out of my eyes, do what I have to do, take my medicine, all that other good stuff. Then the house is still dark here in Arizona. It won't be much longer. I walk by my wife at the computer, and I say, honey, anything going on? She generally gives me three things. She'll tell me three things. And it might be the Bulls won another game, the White Sox did this, and, oh, by the way, Leon Panetta said that, you know, she'll say three things, basically. She's drinking her first cup of coffee. That's all I get. That's all the news I have. I don't subscribe to any newspaper. I don't read the news. I don't have any services. I don't even look at the headlines. When I sit down in my trading room, I pull up charts. I answer my emails. I draw, and I write. That's all I do. I don't look at news at all. I have no idea what the opinions are, and I don't care. It's meaningless to me, okay? And when I owned a prop room, it cost $5 million to buy one of the seats, and I had to like it. There were 6 other people in the room. Excuse me, a total of 6 people, so 5 other people in the room. I came in one day, and they had put in a big LCD, and they were watching CNBC. I called the janitor. I had it thrown out the window. It's junk. It's garbage. It's just a distraction. Everything you need is in price. That's what I believe. If other people believe other things, that's fine. Same thing with Squawk Box. I'm not interested. I don't want to hear that stuff. That was meaningful when you were standing on the floor and you could feel, you know, the adrenaline change or whatever, but that's different. You were a liquidity maker, a market maker, and trading on the floor. But in terms of Squawk Box trying to recreate that live, and I'm not talking about the service Squawk Box, but all of them put together. To me, it's just a distraction, but that's just me. Whales get heavily criticized by retail traders. Does that ever make you worry? Worry about what? So to come get me? It is meaningless to me. I mean, look, I had a lady at Traders Expo stand up. She was about 89 years old, and she wouldn't stop. Security had to come get her because oil was actually on its way. I think oil was about $135 a barrel. It had come off its high at 148. I was actually short oil, but she kept yelling, "You terrorist! You're a terrorist! They should arrest you! You're a terrorist! That's why oil is going up." Look, I'm short and long all the time. I go back and forth. I'm just trying to make money for myself and for my investors, and I can't change oil policy. Oil is going up because there's a risk premium at the moment, and because there are more and more people using more and more petroleum products, and we don't want to use coal and solar and wind and etc. It's not my fault. I just trade to make money. I don't care what people say. I don't pay any attention to that stuff. I've testified on lots of committees. I testify on several. There are people out there that talk about, I call them Build-A-Bear. There's three conferences that happen on a regular basis, and I'm asked to testify on a regular basis, and I do. I'm more than glad to do it, but I don't really care what people think of me. I do what I have to do. How do I mend my conscience? I educate. I give back. Regarding taking time out of the market, is it better to stick with volume chart versus 20-minute chart or switch between them? I would not switch, Doug. Pick one. Now, if volume you mean, I can't even remember the name of them. Equal volume charts, I don't use them. I don't look at the little squiggly volume lines. There's a website called Trading Naked, and I was the first trader that was given the Trading Naked award. Believe me, they didn't have a picture of me naked. It means that my charts don't have any squiggly lines. I just don't look at that stuff. Volume, bar per X volume number of contracts. Oh, okay. Well, I don't look at that either. And here's why. I've looked at all that stuff. Tick charts I look at sometimes. I used to look at range charts. I don't look at range charts very much anymore. As you start to get into that stuff, here's what you're doing. You're obscuring price action. And price action is the end-all and be-all, in my opinion, because we want to get to the important extremes of price and then get them back into balance. And in some cases, if we're capable, we want to also get to the time or space factor, and where time and space coincide with price. And so I don't want to do anything to smudge that up, so to speak. The second thing about volume numbers, Doug, is that, frankly, the volume reported is useless. I don't know if you know this, Doug. I can trade outside of the market and not have my trade recorded. If you're large enough, you can make an off-exchange trade. So, you have is that dark pools? No, it's look. I can call somebody up and do cash oil and have it converted later on, if I want to, or I can just trade in the cash market. You'll never see it. Well, ticks are better than volume. In some markets, I like tick charts better. For example, in bonds, Doug, I like tick charts better than time. But I'm fine with a 15-minute bond chart. But I like tick charts that equivalate about 15 minutes of action. And the reason why is because bonds tend to go flat, then they tend to go a little bit wild. So that tends to smooth out the action. But it's still, tick charts still keep in the major price action. That's the important part thing for me. The drumbeat of regulating speculators is being heard by Congress. Will we not be able to trade oil futures in the near futures or ETFs? Bob, that's, you know what? I've been trading since 1972. I've traded through the oil embargo when we used to drive the car, and if you took the car out at night, you had to take a 5-gallon gas can with you, and you better return home with 5 gallons in the tank and 5 gallons in the jar that you brought in the back of the trunk. Otherwise, Dad would beat you up, and you couldn't take the car next time. I've traded through the Hunt silver spectacle, and everybody was, oh, we've got to stop trading this. We've got to stop trading that. Listen, trading has been going on for more than 7,000 years. Trading is not going to go away, period. People can make all the noise they want. They're just looking for somebody to blame for their problems or for the problems in the world. Traders didn't cause the price of oil to go to 148. If you take traders away, you're going to have real problems because we cause liquidity. We actually take risk out of the market. We let you lay off risk. So don't worry about it. It's not going to happen. I can't give you a box size and point and figure because first of all, I wouldn't tell you what my buddy uses, and second of all, I don't use point and figures religiously. So there are better people to ask than me, and it's also market dependent. Regarding taking time, well, we did time out of the markets. Let's see. Gina says, so you don't use volume? Doesn't that rule market profile for you? Doesn't that rule out market profile? Well, I was actually the original. I was the guy that put up money for the original market profile study, which you probably don't know. And I like it. And I liked it on day one when he made the presentation to me. but it hides too much price information for me to rely on a regular basis. However, there's several people in mentoring that I have that religiously use market profile, and I did not suggest them, and I do not suggest to them that they stop using it. Instead, I suggested that what I first said after 3 sessions was, why don't you just start showing me your market profile charts and let's get it over with. Come clean. Because I could tell what they were doing. Market profile is fine. I have no problem with market profile. If it works for you, go ahead and use it. I don't need to see it. I can see what the information that market profile gets me with regular black and white bars that I show. But that doesn't mean, you can't use market profile. I just don't use it. Oh, here you go. I like that. When I learned to fly, I had hundreds of hours of live instruction to get better and better. Think of trading in live trading room like live piloting, flying a plane. Kind of, sort of, maybe. However, here's the thing, John. There's a difference between let's talk about the markets live, which we do in market geometry a lot, versus let me tell you it's time to get long. Let me tell you it's time to get short. You're not going to learn anything from that. All you're going to do is learn how to listen to me. And when you walk away, you're not really going to have learned anything, because I'm going to spend my time just calling out the trades and then drinking my coffee. So I have no interest in that. I have no interest in being a part of that, and I don't think you're going to learn anything. I would much rather teach you how to trade, and I teach you live on a regular basis. If you want to do that, fine. If you want somebody to call your trades, there's plenty of services out there. I don't think much of them, but that's just me. If they work for you, go ahead. You never liked multiple time frame analysis. How do you save yourself from being run over by the train if you're trading in 20 minutes? Ahmad, that's a great question, but let's think of it this way. Ready? If the 60-minute chart is going to turn up, which is going to turn first, the 20-minute or the 60? No, you have to say 20. Yeah, everything you need. If you're going to trade the 20 minutes, just pay attention to the 20 minutes. Don't worry about it. Everybody is so paranoid that they're going to miss the major. This is like looking for the Holy Grail, okay? There is no major line. There's no perfect line. There's no big resistance level that if you don't know it, you'll miss it, okay? What will happen is the 20-minute will get to that level, and you'll see that price action is showing you there's sellers there, and you'll react. And in the meantime, if you're talking about a 60-minute bar, you'll have had 3 20-minute bars unfold. If you're talking about a daily, look at how many bars would have unfolded. You'll know that there's something going on there, okay? They're not going to sell when it just kisses it. So don't worry about it. If I'm trading tick charts, how do I put pitchforks on a tick or on a 5-minute, 10-minute? Gina, can you restate that? I'm not sure I understand. A tick chart, it's 352 ticks is one of my favorites in bonds, for example. It shows 352 ticks worth of price action, all in one bar. And then at the next, when it gets to 353, it just starts a new bar. So maybe I don't understand your question. It'll look just like a 5-minute bar. It's just that it's built on 352 ticks instead of 5 minutes. Do I put forks on that chart or on a larger time frame chart? No. I put it on that chart. If I'm trading 352 tick bonds, I put all my analysis and I only look at 352 tick bonds, and I trade off of that. My trades are generated right off of that. Do I use pivot points for making trading decisions? Well, Bob, in the old days when we used to stand in the pits, I still have my coats are here. I have one that's hanging up, and the other 2 are actually framed. My wife framed it for me. In the old days, these nice ladies older ladies would walk around, and they would sell pivot points. And you'd buy them by the month, or you'd buy them, give her $20, and she'd smile, and everybody would be holding the same chart, the same little thing. They also did fib services, by the way, and they'd have S1, S2, S3, and they have R1, R2, R3. Okay, and in a certain sense, they're, they work because if you had 300 people in the pit, 100 people in the pit were holding the same piece of paper and paid $20 to the nice lady walking around every morning. Okay, so they're a little bit self-fulfilling. But, I don't want to say the pits are dead. They're not dead. But where's the action in foreign exchange these days? It is in currency futures. I don't mean that it's not in currency futures, but it's not guys standing around in the pits in the Deutschmark pit. Okay, it's all of you sitting around watching. It's me sitting around watching. Everything's being done on a computer. So, in my opinion, pivot points are long past their prime. Here's a great question from Joe. Can you comment on trader psychology? How does one get a correct mindset, especially at my level? Here's the very first thing, Joe. Let me just say to all of you, and I'm the exception of the rule in terms of large fund traders. Most of us have to trade because we need to get up the list to be in the top 10 to take money. I have the same investors that I had in 1985. I have no pressure. I haven't talked to several of them in 10 years, literally, other than, they send me a check. We just don't talk. I have the same amount of money under management for most of them as I did for the last 5 or 6 years. So, there's nothing to talk about. Things are going well. I'm very unleveraged, so when, the what hits the fan, they never have to look at their sheet and go, oh my God, Tim is whatever. No, I'm never in trouble. I trade very unleveraged. So I'm a no fuss kind of trader. It's very nice. So here's the key about psychology. All of you have an edge that you probably don't know you have over all the big traders in the world. You don't have to trade if you don't want to. If you get up and your head hurts, you got a headache, you don't have to trade. If you get up and the phone rings and your son or daughter broke their arm, you can go take care of business. You don't have to trade. Instead of trading and in the back of your mind you're worried about your kid. Okay? If you want to take a week off, you can take a week off. If you look at the charts and you don't see anything, you don't have to trade. Hedge fund guys that are chasing rate of return, at the end of the month, first of all, they get calls every day. How's your day going? They're trying, these ranking services, they're literally trying to rank them every day. They need to be high up the list because they're always trying to attract new investors. You don't have that problem. Here's your problem. Just making money. So, you have a huge edge on these traders, and most traders in the world, certainly institutional traders, because all you have to do is worry about, how do I feel? Do I feel like I'm at the top of my game? And do I like what I see? Is it time for me to trade? If it's not time for you to trade, one of the topics that we're talking about right now in market geometry, I did a study with the NFA recently, and we looked at about 10,000 different accounts. And the question they had was, not anonymously, I didn't get to see names or anything, but 10,000 accounts got blown up. And we went back and we took a look and we said, okay, what's the prime reason? If you could point to why these people blew up, what is it? It's really two things. One is overtrading. Everybody gets drawn into trade too much. But the second thing is they trade. I've been watching the screen for 3 hours. There must be some. Let me just. Oh, look at this twitch. We call it the twitching worm. And so they get drawn into trades that they never should have taken. If you can wait until the market breaks out, as I did in these trades, that's why I did these 2 specific trades for you. Here's a way you didn't have to get in at the bottom. You don't have to worry about the top, and yet you could have taken out more than $20 in oil, which is $20,000 a contract if you're trading bigs, or $10,000 if you're trading minis. And so the key that you have is trade when you're at the top of your game, meaning your focus is good, you feel good, and you don't have any distractions, and wait for the market to start to flow, then worry about getting in. Okay? That's what I would tell you about the best emotional state. Do I recommend compounding profits or trading the same number of lots to become profitable? Okay, Tunde, we have a rule in market geometry. It's called, you have to earn size. Okay, so that means you have to make a certain amount and be profitable a certain number of months before you can add to the number of contracts you're trading. Yeah, sure. My email address is timothymorge@gmail.com. I'll type it on. I'll type it in a minute, or Cynthia can type it. Don't worry about it. And you're all free. Just go ahead and email me. I'll ask you guys a question, and you can just answer. Do you want to be put on a mailing list, or do you feel that's intrusive? I'm just curious. Let's see. Can we grab another one? Do you agree reading price action is more important than drawing median lines? Median lines help frame price action. Doug, I think that's a big word, prescient statement. The problem is a lot of people don't do enough practice reading price action. But if you spend a lot of time doing a lot of playbacks or looking at a lot of charts and marking out swing highs and swing lows, major highs, major lows, and get to understand how a swing high is made, how a swing low is made, and how they play out, and what a range looks like, the question becomes moot, because then your median lines will become 1,000% better as well. So yes, I would definitely spend more and more time on price action. That's why our website used to be called medianline.com. We changed it to market geometry because we wanted to focus on two other things: the market action, price action, and also Amos's work, solid money management and risk reward. Let's see. I'm looking, Cynthia. Oh, should we be concerned with so much government intervention, especially with bonds? Oh boy. In general, government intervention, they have a pretty poor record. No offense to all of you out there that work for the government. If you take a look at the P&L, and I used to be the lead foreign exchange person. You know, they'd call. We had a red phone. It was in the Fed. They'd call up. They'd say, "Do this, do that, do this, do that." If you took a look at their P&L, they're pretty bad at what they do. Here's what they can do. They can push for a small period of time. They can push a trend that's already turned. They can't change trends. They just think they can. And if you take a look at the foreign exchange market, for example, $3, $4, $5 trillion a day go through foreign exchange. Yet when they print that they, for example, the Swiss National Bank, we did $55 billion in intervention today. That's nothing. That's not. You can get a price on. Yeah, I can get a price on $55 billion from from some other hedge fund manager. They'll make me a price on the full amount. So, you know, they're doing. It's more for publicity than anything else. Now, bonds, we're talking about something a little, yeah, your tax dollars at work, exactly, Charles. Bonds, you're talking about something different, I think, Scott. Are you talking about QE, like, you know, adding liquidity? That's a little bit different if that's what you're talking about. Now, that may have long-term implications. One implication it has is, I think the stock market is where it is, which is up, and the bond market is where it is, which is up, because there's so much money floating around out there from all the money that the U.S. has put into the market and the Europeans have put into the market, that there's no place for it to go. It's got to go somewhere. Why? Because people like me have to chase return. Unfortunately, it didn't go to the right place, which is people like you should be getting really easy and cheap mortgages and really easy and cheap loans. And if we had the Paul Volcker that we had in the early 80s, who banged his fist on the table and said, if you're getting money from me, you're loaning it out, and if you don't loan it out by tomorrow, you're not getting any more money. And he cut some people out publicly. So, unfortunately, we don't have a Fed chairman. He says he knows a lot about the Depression, but I think he knows very little about anything, and he certainly doesn't bang on the table. He should be calling press conferences, he should be banging on the table, and he should demand that money be put to work. But that's way off the topic here. My opinion about MF Global and traders not being made whole yet. Well, Cynthia, I think this plays to you. I'm going to answer it. You can tell me if I don't want to step on anybody's toes, but here's my opinion to all of you. Always make sure that your account is in segregated funds. Always. And second of all, you have to know who you're trading with. There's a reason why I do these educational seminars with Cynthia and Interactive Brokers. There's lots of people that ask me to talk. And where do I do? Here.
Well, Tim, I have to say thank you to that. And just for those IB clients or those who are considering about opening an account with IB, please do check out our very prudent risk policies. Also, if you do want to view your account, the segregated portion of your account is clearly visible in your account window, directly available from within Trader Workstation. So there's a lot more on our website as well. Underneath the trading menu, simply go into the margin information and you can find out there's a wealth of knowledge there. But we do put everything out on the website so that it is transparent, that's the word that I was looking for, so that you can all see what our policies are, that we do really want you to be able to trade smart. But with that, looks like we're having some difficulty with sound again, and Tim, I have to thank you for the generous use of your time. This has been fantastic. And I also want to remind everyone in attendance that we'll be doing this monthly through the end of through the year on the second Tuesday of every month. Now, it does take me a little bit of time to get the topic and description, but it will be posted on our website, and you can always access us the second day of the month, whether you've signed up ahead of time or not, by simply going to the education menu on the Interactive Brokers website. You can register and join in one quick swoop. So keep in mind, second Tuesday of every month. But with that, what I'm going to do is we're going to cut this off now because I know there's a lot of people waiting for the recording. So I do want to make sure that I get enough time to get that recording compiled and uploaded and that link directly to your inbox. So thank you. I'm sorry, did I say Tuesday, Mary? My mistake. It is Thursday. It's the second Thursday of every month. So please do leave that, or please do make note. Even put that in your calendar if you've got time. Join us, or if you don't have time, by registering, you'll automatically get a direct link to the recorded playback just as soon as it becomes available. So once again, Tim Morge, terrific presentation. Thank you so much. And I also do want to thank the CME group for bringing us together and making today's event possible. So thank you all for your participation here today, and special thanks to Tim Morge as well. Tim, terrific. Thank you so much.
Thank you, Cynthia. And Mark, it's always good to see you from the CME. I appreciate you sponsoring these along with Cynthia. Cynthia, you give the best educational material out there. There's no other house that I would work with. I just appreciate all the time and effort you put in. And thank you for putting up with me. I know I'm slow,
Tim,
but I do my best.
Tim, absolutely. And we're just grateful for the time that you are able to give to us. So thank you so much. All right.
Can I sign up for next year? Can I sign up for next year now? Oh, I'm sorry.
I don't think we'll let go of you. So.
Good, good.
But
I'm here.
We are in touch on a monthly basis. By the way, everyone, Tim's current webinars, and if you've missed any of the previous webinars this month, simply go to the education menu. There's a webinars link, and underneath the industry-sponsored tab, you'll be able to filter by presenter. So simply locate Tim's name on that list, and it will give you access to all of the recordings that we have archived there with Tim Morge. So a great way to look up and catch up on any of those previous recordings. So thanks again, Tim, and thanks to the CME. And thank you all for participating and for sticking with us this long. Have a great afternoon, everyone, and do remember, trade smart. Thanks all.
Take care, Cynthia. Take care, everybody. Thanks for taking the time. We'll talk to you soon. Futures University, it's located on our website. It's actually called the School of Futures, and those events are, well, let me see, that we are getting topics and descriptions on those events, so they'll be listed shortly as well. Simply watch our our webinars list. We normally have them posted by the 20th of each month, so if they're not out there now, they will be very soon. So thanks, everyone. And the PDF. Thank you, Bob.
Don't forget the PDF. Today's slides will actually appear as you exit the event. It's going to pop up in a separate window. It will also be posted alongside our archived recording on the education menu as well. Thanks, Bob, and thanks to the rest of you. Have a great day.